Greetings everyone, Joseph James here from theschooloftrade.com. In today's chart of the day, I wanted to go over a specific chart that we saw here in live trade room. Now, of course, we open up the trade room every day at 7:45 Eastern time, and of course, when we review the charts, we're always seeing learning opportunities and always seeing some interesting things here on our charts. And I really wanted to point this out to you guys here. Now, we saw this today. Of course, today was February 3rd, 2010, and as you can see here, guys, we're looking at the crude oil futures here. This is symbol CL, right? Symbol CL, and this is the 2010 contract, okay, off the NYMEX exchange. Okay, so this is the CL 2010 contract. Of course, today is February 3rd, 2010. So the chart of the day today, I wanted to point out what I saw here, guys. This happens all the time, and I really think you guys can learn from this. Something I didn't learn until later on in my career. But of course, we all know what these head and shoulders patterns look like, right? We know, of course, you've got the neckline here, right? The head up top here, and right, and here's, of course, your head and shoulders pattern here. So, of course, your head and shoulders pattern, I think we all know what they look like. The way in which the head and shoulders pattern works is you're going to take a break, right, below the neckline here. Okay, so that of course is where you're supposed to be shorting, right? The theory behind the head and shoulders pattern is it's a reversal pattern, right? It's a trend reversal pattern. So once we break below these necklines here, okay, so of course here on 79.80, 79.85, right, we're supposed to be going short here, right? Well, at least that's what the theory says. Now, whenever we see these big, massive head and shoulders patterns, guys, I always remind myself that as a trader, I'm not trying to predict. I'm trying to react. And I remember as a younger trader, I would try to jump in early, right? I thought that I would try to get in ahead of the game and be able to, of course, avoid all the chop and slop around these areas. Now, most professional traders have kind of learned from those mistakes, and they've realized that rather than trying to predict, or rather than trying to be the first person to start selling, right, we kind of lay off a little bit, right? We wait patiently to see, okay, what's going to happen, right? In other words, just because I'm supposed to be shorting here, right, that's what the head and shoulders pattern says, right? Of course, once it breaks this neckline, it's supposed to be just tumbling to the downside here. So, of course, we have to assume the rest of the market also thinks the same way. And a professional trader sees this and says, okay, most of the traders out there, that is most of the retail traders, are probably going to start shorting this thing, right, as it begins to drop around this, 76.90, 76.80 level, right? As people start to see this thing come back and test this, what they call the neckline here, which of course is the break of that neckline would be the short trade here. Well, as it starts to test this neckline, most rookie traders, right, most small day traders out there, most retail traders, will start to short this thing prematurely, right, with their 1s and 2 lots. Meanwhile, all the professional traders are kind of hanging back, kind of laughing at it, thinking to themselves, right, these little tiny onesie twosies aren't going to do much damage because this is a massive head and shoulders pattern. Which means rather than predicting or trying to jump in early, the best way to handle this is going to be to wait for it, right? Wait for it to actually trade through it and then sell a retracement. So instead of course, trying to predict this thing moving to the downside here, right, the path of least resistance will be to let the traders fight over this area, okay, and then let them bring it down, right? Let them push it all the way down here. Okay, let them bring it down and then wait for a pullback. Right? Once we get the pullback, then we can retape, then we can look at my pace of the tape indicator, then we can react. Okay, but trying to predict this thing ahead of time, guys, is going to be a disaster waiting to happen. And you can see here, looking at your charts, guys, right, that's pretty much what happened. We had, of course, right, all the sellers began shorting this thing, and you can see by this hammer pattern here, right, pushed all the way down, and then sure enough, right, the big smart money said, not so fast, we still want this thing back to the upside. It doesn't matter what us rookie traders, right? It doesn't matter what us small onesie, twosie traders think, guys. And that's who pretty much pushed that down this morning. If you were watching at that time, right, we saw lots of 2 lots, right? Lots of 4 lots. We didn't see big 40 lots, right? That's what I wanted to see. We didn't see any of those, though. So the smart money says, I'm going to wait and see what happens next. I'm not going to try to jump in early, even if it means getting in early might mean a little bit more profit on this trade. I would rather wait to react rather than predict. So on this head and shoulders pattern, guys, I always like to bring this up because you can clearly see there, all those small traders tried to push this thing down, but guys, don't get sucked into that. Wait for it to keep moving down. Wait for the move to continue and then trade the reaction. All right, so what do we learn today out of the chart of the day? What do we learn? We learn trade the reaction, right, not the move. I'm not going to trade the falling price. I'm going to trade the reaction, which is the retracement, right? Short the retracement. Okay, I'm not going to trade the move up. I'm going to wait for it to pull back and then buy the pullback, right? That's trading the reaction. Now, ultimately, guys, learning to read sentiment will tell you when to get in short. So when we started to see the neckline there get broken, right? When we started to go back here, when we started to see this neckline get broken down here, right? That's when we begin to use our indicators. Okay, so with the neckline broken, we're now looking for the confirmation that the overall sentiment in the market is to the downside, right? We're not predicting, we're listening to the market, right? There's a big difference between, okay, the pattern says I've got to get short. Big difference between that and the market sentiment says I've got to get short, right? The pattern has nothing to do with it. I'm reading sentiment. The sentiment will then confirm the pattern. That's when we trade. So I look for sentiment to tell me when to get in short. In other words, large sellers, right? Not the little guys. I don't care about the little guys. The little guys, right? All those little tiny day traders, they're the ones that created that candlestick there, right? They're the ones that created that little push down that got sucked right back up. Because the big buyers and sellers, they weren't convinced, right? They weren't convinced yet. So they didn't, of course, confirm the move. We want momentum to be pointing down. We want the pace of the tape indicator as it's dropping to be increasing in speed. We talk about the pace of a tape indicator, guys, as being one of the most efficient ways of identifying short-term market sentiment. Well, short-term market sentiment is also, right, how do I use it? The pace of a tape, when it's increasing, it confirms the move. So if price is decreasing while the pace of the tape is increasing, that will confirm my short entry. We didn't see very much of that, though. All we saw was a big flurry of small sellers, flat momentum, pace of the tape slowing down, and we knew that that short on the crude, guys, would have broke that neckline on the head and shoulders pattern was simply a head fake. So look for sentiment. That sentiment, of course, will tell you when the pattern should be used to take the trade. Now, we always tell people, right, think the opposite direction of your emotions. If you open up your chart and you see that head and shoulders pattern, right, your emotions are going to say, oh, short, 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 right? Let's be a seller. Now, I always tell myself, Joe, think against your emotions, right? Your emotions are trying to trick you right now. So when your emotions say, Joe, get short now, remember, hold on 1 second, let me use my indicators, let me define market sentiment, and then let the sentiment be my guide, not your emotions. And guys, that simply means wait for the market to confirm. If you think the market's going to move down, that's one thing. But when you see the market come in with large sellers, right, pounding those lows, no longer thinking, now you know. So wait for the market to confirm, right? Not just simply getting new lows, guys. We see new lower lows all the time on low volume. Wait for the market to confirm. Large sellers, increasing speed of the tape, higher volume as we start to drop. That will confirm this head and shoulders pattern is destined to drop like a rock. All right, guys, let's recap. Our trade room opens up tomorrow morning, 7:45. Make sure you guys are here for our trade room tomorrow morning, 7:45. Don't miss a tick of that. We'll talk more about these interesting chart patterns and how you can learn to read market sentiment. We also have a webinar tomorrow. Of course, every Tuesday and Thursday, we do free webinars at 11:30 Eastern Time, right in the trade room. The beginner's course is highly recommended for all free trial members. And guys, if you want more information about our lifetime membership, please drop us an email at sales@schooloftrade.com. My name is Joseph James. Hope the chart of the day was informative for you guys. Hope you learned a little more about how to define market sentiment. We'll see you guys in the room tomorrow morning. Bye-bye for now.